How do you separate true CapEx from deferred maintenance? Honestly, I don't. If there's any deferred maintenance, I would set that up as CapEx and plan for it in my budget.
Yeah,
What about you?
same. That's I'm trying to think when deferred maintenance would not end up being CapEx. If it's deferred, it's been a while, it probably needs to be completely redone versus standard maintenance and repairs. Yeah, I agree with you.
Yeah. I mean, if you have railings that are starting to fall away from the building, it's like that's a project that needs to be handled. And yeah, maybe you're originally planning on doing 1.5 million in capex, but then after you do your due diligence and you find all this more deferred maintenance, you have to now get it up to maybe 2 million, 2.5 million. It's still going to go into your capex, but it also gives you leverage against the seller to maybe drop the price or whatever, just because it's like, hey, you haven't even been maintaining this. I'm buying a 1970 something property, but it's in 1950s condition, and so you can't sell it at the premium you're asking for because it's not in the condition you're trying to sell it at. So welcome to the Ironclad Underwriting Podcast, where precision meets performance in commercial real estate. I'm your host, Jason Williams, and every week we deep dive into the strategies and systems and stories behind rock solid underwriting. Whether you're a seasoned analyst, an up and coming investor, or a commercial real estate professional looking to sharpen your edge, this show is your front row seat to expert insights, emerging trends, and real world underwriting tactics that stand the test of time and scrutiny. From market assumptions to debt structuring, cap rates to cash flow, we're cutting through the noise and getting to the numbers that matter. So sharpen your pencils and fire up those models. Let's get to work. This is Ironclad Underwriting. Hey, everybody. Welcome to this episode of the Ironclad Underwriting Podcast. I'm your host, Jason Williams, and got my co-host, Frank Patalano, here with me. And this is actually a pretty special podcast because if you've been around for the whole journey, you've been listening to us for right about a full year now. When this episode airs, we will be right at the 1 year anniversary. So that's pretty cool, I guess.
Definitely. Episode 52, that's what you're telling me?
This one will be episode 53, I think.
All right, yeah, sounds good.
So, and to honor this special occasion, and honor everybody who's been listening, I've been getting a lot of questions throughout the year from listeners of the podcast, and so today we are going to do some Q&A from some of the old, or some of the questions the listeners have been giving me. So, you ready to get going?
Oh, yeah.
So, and these are in all different categories from all different podcasts. So, most of these we've already talked about in depth, but like the specific questions we're going to go into here. So, all right. So, I shall begin. This one question is about debt and financing. And really, it's like a fixed rate or floating rate. Honestly, what I tell people is I prefer fixed because I don't like surprises. Um, but really, if you can get a floating rate and you can get a rate cap, which I recommend you do, and your numbers still work out, it could be beneficial for you. If and rate caps, we've gone into this in one of the lending episodes, they can be expensive, um, depending on how long your rate cap is, how low or the cap is. So if you don't want to get over whatever percent, then the lower it is, the more expensive it is. Because essentially it's just an insurance policy to cover everything above a certain interest rate for a certain amount of time if the floating rate goes above it. So if it has to make sense, and can you afford the rate caps? Really. And I believe in fixed. What about you, Frank?
I'm just trying to think of times that I would be interested in floating rate debt. I would say that fixed rate for me is usually the way to go because there's so many different variables, and I'm trying to narrow down the number of variables. This is a real estate's not the easiest thing to do, so the less things I have to guess on,
Yeah.
the better. Yeah, I know what you're saying, and we've I don't think I can't remember the last time we did a floating rate debt, so I could be wrong, but
I never have done floating rate. Um, I I don't consider a rate change every 3 to 5 years floating rate.
no, I don't either.
I consider floating rate where you don't even know what your debt service is each month, unless you've already hit your cap, and then it's going to be maxed out. My mentor has some floating rate debt, um, but almost every single issue that people have been facing lately are due to floating rate. It's either due to cap rate or rate caps expiring, not getting renewed, not being able to sell before the rate cap expires, and so they get themselves in a world of hurt. So I say fixed on this one.
Turn for a question.
Yep.
Let's see. Since we're talking about loan terms on that one, let me pick one that's loan term related. What loan terms are easy to overlook but extremely important?
I think for this one, they a lot of times lenders don't necessarily come out and say it, but the DSCR requirements that it's like, yeah, when you get a loan, that you might have a DSCR of 1.25 or 1.35 or whatever. But what you don't know is you have to maintain that every single month. And if you drop below that, you're breaking that loan covenant. So it's not just a one and done thing. It's a you need to maintain a 1.25, 1.35 DSCR each month. Um, and even if you're making all your loan payments, they can call the loan due if you drop below it. So and they might give you some leeway if it's only like 1 month or 2 months that it happens. But if they start seeing a pattern, you need to start talking with them before they start talking to you. What about you?
Um, the one that's been catching me the most in the past few years is when we've borrowed money and we've borrowed money for rehab, and when we're paying interest on the money that we've borrowed, but we can't access it yet. What do they call that again?
Or like
Um,
a Dutch loan?
yeah, Dutch loan. There you go. Yeah, so you borrowed $4 million and you borrowed 1 million for rehab. You're not touching the rehab money yet, but you're paying interest on the money you're not even able to touch. That drives me
This is
nuts.
so you're paying interest on a $5 million loan when you've only used 4 million of it so far.
Yep.
Yeah, that I hate that as well. Next question. We got a series of a few Cap X questions that we'll go into. Um, how do I underwrite interior renovations? This one is actually pretty easy. Um, it's actually you get more information after due diligence than before, because due diligence you should be walking every single unit, and when you walk every unit, you're taking note of are the appliances in good shape, are the floors in good shape, do the walls need painting, are there any leaks, countertops need resurfacing or replacing, tubs, how are they? So you when you walk a unit, you get all the information you need, and then ideally you want to get a full report from whoever walked the units. Usually it's like a due diligence team, and they'll go through. It's like, all right, unit 305 needs blah 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 blah, and then so then you compile the whole report and you figure out, all right, we need so many floors, so many cabinets, so many doorknobs, so many cabinet fixtures, and so you can start figuring it out that way. um, and a cool thing about the Ironclad software I've developed is you can go in and you can select each item. Like you can go in and select counter resurfacing, and it will give you an estimate about what it will cost. So if you don't know the exact cost of it, you can at least get somewhat close in the general ballpark. So that's how I would do interior renovations. What about you, Frank?
I think that it's hard to do it before you walk the property. Um, but usually I would classify it into like three different types. Things that need almost no work or light turns, medium upgrades, and then large upgrades.
Yeah.
And then I
Another
price out each one and figure an estimate on each.
another thing that I do is generally a low to mid upgrade or rehab of the units would be about maybe 2,500 to 5,000. I think a good mid would be about 5,000 to 7,500, and then a big upgrade would be like 7,500 to 10,000. If you go over 10,000, you're basically redoing the whole unit. And again, it depends on the size. So if you just tour a property and it looks pretty good, and the units you looked at don't really need much, you can put one of those numbers in just as a ballpark, just to get started before you actually do your due diligence.
I think some of that might be
And it's definitely
markets.
market driven.
Yeah, so
So
I mean, I'll just jump into the next question since we're talking about this. Is a $10,000 unit renovation budget enough? And I would say that in most markets, depending on the quality of what you're talking about, it's not. When you said 2,500 for that, I mean, I've seen paint almost cost $2,500 for a whole unit, depending on the size of the unit.
yeah.
Between labor and supplies. So, and it also depends on if you're paying for an extra a different a turn team versus someone that's already on property. But I mean, we're doing turns right now on a property in South Carolina, and it's not a Class A property, and we're averaging $18,000 a renovation. So,
Okay, so look, I want to justify my numbers I just spit out as the markets that I invest in are
yeah, yeah,
those.
no, that's fine. Actually, it's your turn to comment on it. Is a $10,000 a unit renovation budget enough?
In my market, yes, it is. We've turned units anywhere from on one property 4,500. I think our biggest one was like 7,500. We have another property that we have gone a few units over 10,000, but generally we have been staying under. I think right at 10,000, 9,500, 9,700, something like that. So in my market, yes, and in other markets, and I'm in North Texas and mostly a secondary, tertiary market, so things are a little bit cheaper. You go to DFW, Austin, um, you said South Carolina, Florida, you are looking at more per unit, and so
We had one in Rhode Island that was a $20,000 rehab, and it's like, guys, you didn't even do the cabinets. There was no major changes here.
yeah. So, another one is what capex items are commonly forgotten, and I'm also gonna say this as maybe underestimated. But if you ask my wife, she's gonna say plumbing. Add plumbing to it and then multiply it by four, because every single one of our properties has had plumbing issues, drains collapsing, roots growing in them. And you can scope a drain all you want whenever you do your due diligence, and it could be fine, but that means nothing because grounds can shift, and all of a sudden a pipe just collapses and you're backing water up into units, and you're evacuating people, putting them up in hotels. So, yeah.
You stole my answer when you said plumbing. Just this the same thing is especially when you have something built prior to 1980s or prior. We've been scoping all the lines, the water lines and the sewer lines, doing all that. And yeah, there's a lot of expense there. Another one, I guess, besides plumbing, I would say would be electrical. There's been a lot of deals lately where we've had either stab locks or some 1970s electrical panels that are not really in code, or insurance companies don't like them anymore. And those can get rather pricey to turn over, on a 100 unit, 200 unit apartment complex,
Yeah.
one step at a time.
Yeah, and you can go through and you can do all your due diligence and everything be fine. And then when you get your loan or you get your insurance, all of a sudden you have to do more based on whatever they had. I mean, we had to go in one time and put in railings were too far apart. We had to go put in like rebar between them just to keep them under 4 inches or whatever. So I mean, that I wouldn't even call that forgotten. I mean, that was never an issue until our new insurance company came in and said, "All right, you need to do this, or you're going to lose coverage." It's like, okay, I guess we have a new capex project we're working on. So,
Um, all right, let's ask. Is it my turn or your turn? I can ask the next one, then you can do the one after
Sure.
that. When we think about deal underwriting and assumptions, what is a deal breaker assumption for you?
Deal breaker assumption.
Yes,
And we're not talking about assuming the existing loan. We're talking about the assumptions we're putting into our model.
that's what I was thinking.
Um, uh, Rents right off the bat. If it's like really high, abnormally high without a reason, that is a deal breaker for me. I'm not even gonna consider it. Most of the time, what I would do is if I can put in the existing market rent that they're currently leasing at and the underwriting and the deal works or somewhat works, is close to it, it's worth moving forward. But if I have to increase rents like $450 right off the bat just to make the deal work, that is a huge red flag. And
That's a big number.
yeah,
For me, I was thinking more on the underwriting side. Whenever someone shows me a deal that in order to make money, you have to have cap rate contraction
yeah.
versus, cap rate expansion. If that's the only way the deal can make money, it's like, yeah, I can't do that right now. We still don't know where interest rates are heading right now. And the typical, I mean, you and I have talked about this before. Typically, you're talking 10 basis points a year. There was a little bit of time where I think we were figuring 20 basis points a year.
Yeah.
So,
What return metric do you trust the most?
I think I like to use AAR, the average annual return. I'm not a big fan of IRR overall, just because it sounds better, but sometimes it's nice to talk about getting your money back quicker, but I don't usually see it happening.
Yeah.
I guess I just want to see it averaged out. What do you expect on the deal on average to get for a return? So if you're supposed to double your money in 5 years, 100% divided by 5 years, you get about a 20% year over year.
So I was thinking, I don't know. I mean, trust is kind of weird, especially in this question, what return metric, because one assumption affects all of them.
There you go. Yep.
So it's like you can't trust one over the other because you're trusting the assumptions going into it. And so you might get 18% IRR or whatever, and a 25% AAR and 8% cash on cash or whatever. But you change the cap rate, exit cap, and all of a sudden everything shifts. Except the only thing that won't shift right there is your cash on cash, because that doesn't depend on your exit cap. So I guess in that regard, but if you do change like your rent growth, that will change everything plus your cash on cash. But the number that I like to look at the most is the equity multiple. If I see I'm going to be putting in a lot of work, doing a lot of rehabs, and I'm only getting a 1.6 equity multiple, it's like it doesn't seem worth it to me. So I'd like
That,
to
that
get,
was that was high up on my list too, but I was just figuring that with an average, you're already going to get that part of the math in there.
yeah.
Just figuring the number of years. So with that being said too, I mean, if you're doing a 3-year deal, if you're at a 1.6, that's still the same AAR as a 5-year deal at doubling your money.
Your IRR will be through the roof though, just because it's a lower hold time. So
I'll, I'll believe it when I see it sometimes on those IRRs.
yeah.
My turn for a question. Let's see. At what point do you generally ask the seller for loss runs?
Okay, this is a due diligence and insurance question. So what I do, every LOI I submit, I put it in that I'm going to be asking for this. So you might as well get them ready if we get under contract. And then once we get under contract, that is one of the items that the seller owes me. So that's when I do it. When you walk or tour a property and you notice something that would have been like a big insurance claim, you can at least start like making mental notes of, all right, these roofs or this unit burnt down or something was replaced recently. You can look in the news if there's anything newsworthy, it's going to affect your insurance. So you can start doing that mentally, but ultimately you're going to get it during your due diligence time, and you ask for it, one, when you submit an LOI, and then two, you make sure it's in the contract whenever you sign it. So
For
mm,
me, Yeah, I'm thinking that I wouldn't necessarily ask for it too early because if you guys aren't even on the same ballpark for a number, I mean, on the flip side, the seller knows they're going to need to ask for it eventually. But yeah, I like the idea of waiting till after the LOI is accepted.
In all of my LOIs, I put in, and I have an LOI sample on in my vault on my website. I put in all the due diligence items that I'm going to be requesting. So I have a list of 20, 30 things, and it's going to be in there. So, um, and it is something that I feel should be automatic that the seller would hand over. It's just like them handing over all the leases for you, so you can do a lease audit. It's just one more thing for them to send over in a in their usually what a Dropbox or something of all their content for you. So, how do you separate true capex from deferred maintenance? Honestly, I don't. If there's any deferred maintenance, I would set that up as capex and plan for it in my budget.
Yeah,
What about you?
same. That's I'm trying to think when deferred maintenance would not end up being CapEx. If it's deferred, it's been a while, it probably needs to be completely redone versus standard maintenance and repairs. Yeah, I agree with you.
Yeah. I mean, if you have railings that are starting to fall away from the building, it's like that's a project that needs to be handled. And yeah, maybe you're originally planning on doing 1.5 million in capex, but then after you do your due diligence and you find all this more deferred maintenance, you have to now get it up to maybe 2 million, 2.5 million. It's still going to go into your capex, but it also gives you leverage against the seller to maybe drop the price some or whatever, just because it's like, hey, you haven't even been maintaining this. I'm buying a 1970 something property, but it's in 1950s condition, and so you can't sell it at the premium you're asking for because it's not in the condition you're trying to sell it at. So
Sorry, I'm laughing about you saying 1950s condition. Maybe it's a 1970s property in 1990s condition, which is still 30 years ago. Um, Next
uh,
question. What sponsor fees are reasonable?
okay, so this one I would say acquisition fee is reasonable.
Well, what
Typically,
percentage?
you want those. I've seen them anywhere from 2 to 5%. I would say 2 to 3% is reasonable. 4 or 5% acquisition fee is unreasonable. Refi fee, that's getting in the shady areas. Like, yeah, it does take a lot to do a refi. Should the sponsors get paid for that? I don't know. Disposition fee, do they get a fee up for selling it? I mean, that's kind of shady in my regard too. I think all the work is done on the back end, and then everyone benefits on the sale. So I don't know what's your take on that. And again, a disposition fee, refi fee. I've seen those. I've seen sponsors charge 2%, sometimes 1% on a refi, 2 on a sale.
I like the deal to be as clean as possible. So I'm not a big fan of being feed to death. I agree that a 3% acquisition fee is pretty fair and standard. I think anything above that is too much in my eyes, as an opinion. I don't see almost any other fees that I'd be happy with. I've never done a deal, and I've invested as an LP in a dozen deals, over a dozen deals. I haven't done any where there's any other fees involved. I would consider a refi fee of a 0.5% or 1%. I think I'd be okay with it, but still beyond that, I don't consider it reasonable. There's
Asset.
also there's also the asset management fee as well.
Yep.
3% at most on that.
I would say 2 to 3% on the effective gross income. I have seen asset management fees on the full capital raise.
Oh yeah, no, no.
And the justification on that is, well, I'm managing that much money for this property, so that's why we're doing that. I did
No, I
not
agree with you
invest.
based on rents.
I did not invest in that project just because that was really ludicrous. I don't like getting feed to death. I don't want to fee anybody to death.
I have seen
Um,
development fees on developments as well. But I haven't invested enough in them to really have an opinion on what's too high of a rate.
If you have a contractor on your team, like a general contractor or something who does that for like a living or whatever, or has a history of it, and they have a contractor fee because they're going to be managing all the capex projects and stuff, I could see a small percentage for that as well.
Yep.
Um, because sometimes you have to go out to a third party and pay that anyway. Sometimes up like 10-15% on everything. So I can see that as a sponsor fee as well. So what questions should you be asking during a property tour? So I actually usually when I walk a property, I go with my wife, Angel. She's the talker. She's the personable one who like carries a conversation with a broker and everyone, and I'm the one taking pictures and going through all the cabinets and seeing what kind of electric panels there are and everything. But the last tour I went on, she was out of town, so I had to do it all myself.
Uh-oh, doing it all himself.
Yep. So one thing I always ask is why is the seller selling? Um, Sometimes they're tired landlords, they want to retire. Sometimes it's other syndicators and it's coming up to the end of their business plan. And so they just want to get out, get their investors their money and move on to the next one. This last one I walked is a family office who's just trying to liquidate some deals to purchase another deal. And so they're selling a couple of their properties to get some of their liquidity. So what about you?
So to make you laugh, I actually haven't been on many apartment complex property tours. I've been on a lot of smaller projects, but most of the time I'm getting involved in deals right around the property tour time, or I do like to visit properties as early as possible when I'm participating in the deals. Yeah, I would ask questions like how old are the roofs? How's the plumbing? Um, how what's the worst insurance thing that's happened recently? I'd be asking those kind of basic questions. What's the current vacancy rate or occupancy rate?
Yeah, and every unit I walk, I always ask them, all right, what's this unit going for? What's this
Yes,
unit
and
going
I
for?
if the tenant's there, I ask the tenant. I don't ask the person. I don't ask the person showing me.
So I usually go with the on-site manager and then the broker. And the manager is usually the one who answers those questions. So
You know what I've asked sometimes before? If the tenant there seems like they want to interact a little bit, I'll ask them what's the biggest problem on the property, or is there any kind of maintenance issue that hasn't been taken care of?
yeah, and I always ask, and this one is for the broker, not for the ears of the manager. Is what's the whisper price? What is the goal you're hoping to achieve? Just so I can one make a mental note of it. So that when I'm running my numbers, I don't want to come up with I can buy this for 21 million, but they're only wanting 14. It's like well crap, I just overspent by $7 million. So it's like
Yeah.
what's a whisper? Just so you have a target. Generally, it's the other way around. I come in a couple million below their whisper. So, but um, this one, we actually have quite a few more questions, and to keep this episode from getting too long, I think we need to break this up into maybe a two-parter. What do you think,
Yeah, I
Frank?
think we should do one more episode on this. There's a lot of questions that we're not going to be able to get all the questions, but maybe one more with some of these big questions.
All right. So, if you do want to learn more, we've generally talked about all of these throughout the year. And like Frank said, we have 52 episodes out right now. This one's going to be 53. So go ahead and listen to them. And if you have any questions, feel free to reach out. You can reach out to me via LinkedIn or through my website, ironcladunderwriting.com, or through Frank. And maybe I should set up an email questions at ironclad underwriting or podcast or something so people can just,
Questions at ironcladunderwriting.com.
yep. Or I do, what was it, one of those morning shows, email anybody but me at whatevershow.com. Remember, you ever hear those? So, all right. Anyway, we'll catch you next time. Next episode will be again more question and answers, and we'll get to your question if you ask one. So we'll catch you next time. Bye.
Thanks.
And that's a wrap for this episode of the Ironclad Underwriting Podcast. If you got value from today's conversation, make sure to subscribe, rate, and share the show. And don't forget to connect with us on LinkedIn, YouTube, Facebook, Instagram, or check us out at our website at ironcladunderwriting.com for more insights and updates. If you have a question, a deal you're analyzing, or a topic you want us to tackle, shoot us a message. We'd love to hear from you. Until next time, keep your assumptions grounded, your models sharp, and your underwriting ironclad.